Good afternoon. Welcome to this webinar from Nebraska MEP. Real excited for today's guest, Byron McFarland of the McFarland Group. We came to know Byron through a client. So that's a great way to meet a potential third party when somebody is so happy with what they've learned or the value they've received that they bring their name to you. So I've gotten to have some good conversations over the last few weeks. And I think more importantly, seen him work with a client that was facing the need to transfer ownership. So nobody owns anything forever. I think that moment always comes at you. And it was fun to see him work closely with a client and really care about getting the best result, getting the transaction to happen, but also caring for everyone involved, all the different, the buyer, the seller, all the different family members. There's just a lot going on. And I think this is one of those moments in your experience in owning a business that is really, really good to be prepared for. So excited to listen in, but I'll turn it over to Byron. Thanks.
Yeah, thank you, Matt, for the kind words, and I'm happy to be here today. My name is Byron McFarland, and I'm a managing member of the McFarland Group, where we've managed to help about $2 billion in business value get transferred from one generation to another. And today I'm going to walk you through what I would call the early stages of of getting into the process. The reason I'm doing it this way is that the majority of business owners I've worked with have had a hard time figuring out how to get started. And so today I want to introduce you on how to go about getting started, and then perhaps coming up with some way to move forward into your own planning. So my agenda here is I'm going to walk you through basically what your targets might be early on in the form of goals. And then if you were to start, what would starting look like? What would be, say, the first 3 steps that you might take? And then further, what are the different exit paths that are available to you as you're thinking about the disposition of your business in the future? And then from there, what would be the timetable for completing any of those various paths, so that you got a sense of when should I be started in advance of the event, and how long does it take normally to get it done? And then we're going to look at business valuation as a concept and some of the key drivers of business value. And then I'm going to share with you a concept I call the T value that is really important for closely held business owners who are looking to cash out and move on. And then I'm going to introduce you to some ways to provide some financing or actually build some business or build some balance sheet for your key employees if your exit path is to sell to your management team, or if you're looking just to retain the talent through the sale, through and to the sale. And then finally, how do you go about incorporating banking into the transaction? So that's our agenda. And there's roughly 5 million businesses, as I understand, that are still in the hands of baby boomer business owners. So hopefully we're chipping away a little bit at the resistance or the procrastination that usually comes with thinking about doing a long-term plan. So let's talk first about goals, shall we? It's been my experience that I can break my clients' goals down, which we, at the very beginning of an engagement, spend a lot of time clarifying what it is that they want to have. And those 3 goals would typically be in the form of financial or time freedom. Second would be potentially a legacy, or if they're located in a market where they're the dominant employer, they might be more interested in what's the impact on the community. If I think about the disposition of my company and changing hands. And then third would be, what's my identity? Entity. And what lifestyle will I have when I subsequently move on, when I'm no longer involved in maybe the day-to-day, or I'm involved in a reduced capacity. So the financial and time freedom is where we're really trying to clarify what resources would be necessary in order for the owner to be financially independent. And quite often there's quite a bit of lifestyle that the business owner is looking to replace. The legacy in the community would be more along the lines of, if I'm thinking about handing it off to family or certain key employees who have come to become maybe like family, they maybe continue my legacy. And then for those who are in a community where your organization is employing a substantial number of the residents, then maybe the community might be one of your priorities in the plan design. And then finally, in all business owners that I've worked with, there's a real need to have an identity that isn't just removed from them suddenly. There's a desire to have some transition into a new life. So how do I go about transitioning from what I've been, the CEO or the head of a large organization, and now I'm moving on into this semi-retired or fully retired state? What is that? What do I need in the way of help in migrating from those from that emotional condition? And so where does a guy start? And if I was advising someone that was thinking about either doing it themselves or was going to look at doing it with another advisor, the first place that I would go to is know your number. And the number I'm referring to is what would it take after tax, after fees, after bonus payments to key employees, in order for you to be financially independent. And with that, I would suggest that you work with a financial advisor, someone who has a planning tool that can formally incorporate the multiple scenarios of your business transition occurring, include the real estate income that's probably might be associated with the buildings that your business is located in, other investments, whether it's farms or ranch or marketable securities, but being able to input those income streams into a model to show you just how reliant you would be on your business if you were to suddenly sell it and retire. The second thing is to know the range of value that you have in your business. And from there, I would hire a valuation advisor to conduct the valuation, and they could take into consideration, market forces and the industry that you're in, the specific sector of the economy you serve, and then look at that as maybe a range. This is what the range of values. We wouldn't need it to be of the highest standard yet, because we're perhaps not looking at transferring any property to anybody yet, but it's more of a, do I have enough in value to actually fill or exceed the amount of money that I determine that I need in order for me to be financially independent? And then the third is to know your team. And what I mean by that is have a formal evaluation done of your team to understand what they're capable of, so that if you are looking at an exit path that would be selling to outsiders, what are they capable of in terms of managing the organization through the transition? If you're looking at transferring to management, what are they capable of in terms of assuming the responsibilities that you have? And then more importantly, are they capable of inspiring the other people in the organization to continue to perform at a high level? Are they going to be able to compel a lender to feel convinced or safe that they're going to be capable of running the organization in the future, absent your involvement, and then be able to earn enough income to pay off that purchase loan? So those would be things about knowing the team. So we commonly will, very early on in the process, will We'll get real clear on what the owner needs in the way of financial resources by collaborating with their financial advisor. We'll work with the valuation advisor to get clarity on range of value for their business under various circumstances. And then we'll either do an assessment of the team or work with the management consultant to do an assessment of the team to understand where everybody's at. And if it's going to be a management buyout, then we're looking at that team from the perspective of how would a lender perhaps be evaluating those individuals if they were looking at making a loan to them now. So let's first do the goals, then get started doing the early stage preparation. So then the question is, like, what is my exit path? And I like to use this example here as a way to illustrate the various exit paths in the form of an outcome. It's not common that people know exactly where they're going when they either buy a business or they build a business up from scratch. It's not altogether that common that they know exactly who they're going to sell it to. So quite often the exit path kind of arrives as a form of a journey of awareness of like, oh, the market is telling me that this is the time for me to be looking at selling to a consolidator, or I'm of the age where I need to be thinking about it. And I've been talking to my management team about, maybe someday this could be theirs or your children could be that. So there's kind of an evolution. It's been from my experience of what path the business owner will choose to take. So this illustration of this mountain here that I have is really based on what we perceive to be the value that one might get from the various exit paths. And it's been my experience that the highest value in the terms of an exit outcome for businesses that I've worked with is that they would sell their company here to a third party. And that third party could either be a consolidator or even a competitor. But it typically is be some organization that has resources and can fold the business in and achieve some economies, either an overhead reduction or reducing cost of goods because they get better purchasing terms based on the volume, or expand their footprint, get the market share in a greater geography that then allows for maybe some economies in distribution. But the highest value that I've seen is when a business is sold to outsiders. Now, then the other 2 points here that I've got is that this point here could either be an ESOP or a person who's has money and wants just to basically buy themselves a job. But typically I see a higher value in businesses that are sold to an ESOP, but not as high as the value would be if they were to sell to outsiders, is because of the ESOP has greater ability to pay. If it's an S corporation and they go to an ESOP, the ESOP is a qualified retirement plan for those who are not aware. And that qualified retirement plan allows the stock to be held in the ESOP trust and no income tax on those earnings. So if you had, if you had 30 or 40% more money after, your year was done, chances are you'd be able to use that money to buy a more valuable asset. So typically I see a little bit higher range of value on ESOP. It's not a hard and fast rule, but by and large, that's what I've observed in my 20-some years of performing this service for closely held business owners. Then the third is the management team. And selling to the management team could have the same value outcome as the value of in an ESOP, but management tends to have very few in the way of resources available to them to contribute to a purchase price. And if there hasn't been any planning done in advance, then chances are the management would have, maybe 10% of the purchase price available. And that really puts a drag on the availability of funds that could come from the bank to help finance it. So that tends to have downward pressure on value. So what we tend to do in a management transition is achieve the value objective by structuring terms, payment terms, so that the owner is getting a combination of sale proceeds, some ongoing income, and either as a deferred compensation benefit or some form of discretionary expenses that are continued to be paid by the company, health insurance, continuation, long-term care, automobile, and related costs, travel, some travel. But there's quite a little flexibility in designing plans. Now, over here on the right, I'm showing this parachute, and this is representative of a full exit of a business owner. And typically from my experience, when an owner sells to a third party, there's a desire of the third party to keep the owner on to a certain degree for a little while, but by and large, most of the buyers are looking to get what they need from the seller and then let the seller move on. So the seller basically goes away and then might get 80 or 70% of their purchase price, whatever they sold, their sale value in cash, but yet they can go away and perhaps, and from our perspective, our guidance to our clients is whatever you get in cash at time of closing and sell to a third party, that amount needs to make you financially independent, because the risk of getting paid for the 20 or 30 or whatever the retained interest is there. And those buyers are very smart, and they're very practiced in figuring out ways to get out of paying full value for things, from my experience. Now, that's not always the case, but by and large, our guidance is that you want to be financially free. If you sold to a third party, whatever they gave you, that should be enough to make you feel safe. If you sell an ESOP or management team, then you're probably going to be interested in what's going on, because there's going to be a piece of that transaction that perhaps you had to assume as part of a note or some ongoing payment method, either through deferred compensation or consulting agreement, or maybe even you had to retain an ownership interest in it. But you're sitting there, you're watching what's going on in either that ESOP or that management, because you're looking for money to come in that's mailbox money, either through installment payments that are periodically paid, through earnings, or through some form of deferred compensation plan. But at some point in here, at the early stage, there would be some analysis done, probably in the value range. What do any one of these three exit paths look like, and which one of those exit paths is going to solve my problem or make my goals satisfied, financial goals in that. And that's usually how business owners who have a choice will make their choice, is that, am I going to be okay if I sold to management or an ESOP, or do I really need to go out and find a third party buyer? Because I don't know whether or not my management team is capable of doing it. Because in an ESOP, you're still going to need your management team to be able to run operations, just like you would if you sold to a management outright. So then, if we took any one of those exit paths, if we took the management or the ESOP or the third party sale, what's our timetable? And I'm going to use the third party sale first. And the biggest effort in a sale to third parties is due diligence. And so when the buyer presents themselves, they're going to ask the seller to provide them with all manner of documentation and financial information. And the buyer is by and large looking for risks that could adversely affect the buyer, which could then be put into the terms of the payment, some form of carried interest, some form of money put in escrow, et cetera. But all of our clients we recommend that we've worked with, if they're going to sell to outsiders, then at least 1 or 2 years before they're thinking about selling, go into a pre-sale due diligence effort, which would be have either audited or reviewed financials, if you haven't been doing audited or reviewed financials, you'd want to have at least probably 3 years of audited or reviewed. The bigger the transaction, the more pressure there would be on having audit, but audited or reviewed to be, at least an effort towards normalizing your earnings. Get a quality of earnings study. Do I have any concentration risk, et cetera? Look at your HR. Do we have any HR issues that have been unresolved? I mean, that tends to be the biggest contingent liability on a business owner's business balance sheet. So we usually recommend that somewhere probably 1 to 2 years before selling to an outsider to do your own pre-sale due diligence, working with an outside advisor, whether it's a brokerage or a CPA firm or somebody that has expertise in that. Now, for management, this one takes a little more time. The time is in the creation of buyer's ability. So we're looking at our leadership team and asking the question, are they capable of assuming responsibility? And if there is, let's say, a gap in their ability to assume responsibility for the roles that you're playing, then we need to start formally developing these individuals and figuring out who is going to be the successor CEO and what do they need in order for them to be able to play that role. Because not only do they need to be able to play that role, but they're going to need to get to know this person over here in the bank and be able to convince that lender that they're bankable. And the way they do that is by delivering results and then bringing the lender in on the experience, on the results, showing the lender how things are working. But it takes time typically to do that, to develop that skill. And then the second piece of that gap is going to be financial resources, which is we're going to need to create something for these key employees so that they have some resources available to contribute to the purchase price to allow for the lender to ultimately do an evaluation and make a determination of how bankable the transaction is. So it's been my experience that if we're going to sell to management, then we're basically looking at capacity and creditworthiness. Those would be the two big initiatives in the build up to a sale to management. And I would say that it's a 3 to 7 year. 3 is an accelerated pace. Done it. It can work if the circumstances are right. The circumstances would be the seller is willing to stay in the business as an owner and subordinate some of the debt, and the business is growing and can perhaps accelerate the pay down. But typically it's a 7-year deal. And we've done a construction company that was using its balance sheet to support its work plan through indemnification, or not bonding and indemnification. In order for them to do the work plan, they needed to have an unmolested balance sheet of several $1 million. And so in order for us to create a transaction where the buyer could step in, we needed to create resources for them. And that took us exactly 7 years to do that. So I would say for management, it's 3 to 7 years. For an ESOP, it's a bit of a combination of the two, but with an ESOP, what we're really looking at is the feasibility of the ESOP to have the right mix of payroll and then have a team that's capable of running the organization. It can still have the owner involved, but we're looking at really the financial analysis. There's a lot of financial analysis, and that's all done by ESOP advisors. And it's been my experience, this can get done quickly like this, but I would say if you're looking at an ESOP just to understand how the ESOP works and how it's going to affect you as the owner and the way that the debt's going to be structured, and there's the inclusion of warrants potentially, and then you got regulatory issues with ERISA and the Department of Labor. So it's a fairly complicated transition. It's worth it though, because the rewards can be there for both the seller and for the employees. So I don't have a hard and fast on NISA, but my best guess would be 2 to 3 years in advance would really help. The longer you give yourself in advance of the exit event, the more likely you are to get what you want, which is sell to the person you want for the value you want on the terms that you can accept. So there's that message. Now, value. From my experience, value is a bit of an art, and that you're generally asked what's the purpose of the valuation. If it's for you to get a sense of what your business might be worth in the market, you're going to get a range of what it could be. They might use multiple methods, future earnings, historical earnings, combination of those two, plus some recognition of assets. If you're an asset-based business, which I'm assuming manufacturing, you'd have all your equipment and plant and materials, or all that would all be assets. So there's probably some inclusion of that in the mix. But by and large, from my experience, the formula for values tends to be cash flow times a multiplier. It can, not all, but most valuations I've seen tend to be some multiple of cash flow. And the multiple or the cash flow, the recognition of the cash flow, is subject to these S and these T's. And is how sustainable is that cash flow? And sustainability is around concentration. Some forces that adversely affect sustainability is concentration of revenue on a small group of customers. Like, for example, we've seen clients who do very specialized services for Microsoft or American Express, and they're representing 70 or 80% of their business's revenue. Microsoft or American Express have been their client for years, but still it's a concentration risk of revenue. So any buyer would have to consider the possibility that those large counts could potentially go away. So the willingness to pay a large high value or goodwill value could be pretty low. And so we're always looking for sustainable issues, which would be concentration, like in market forces. Is there a new competitor coming in? And then as many of you probably experienced in 2022 or 2021, the supply chain just was totally disrupted. And some businesses were unable to get products manufactured or get the raw materials they needed to manufacture the product. So sustainability issues, stability of supply chain, reliability of vendors, things of that nature have a lot to do with sustainability. And then the T is how transferable are those earnings. So classic example is you have an entrepreneur who perhaps is probably a founder who plays all the senior roles, maybe has all the great relationships with the clients, knows how the sausage is made better than anyone. And so the organization is really relying on them, and everybody comes to them for answers, this person. And then they're thinking, well, I want to sell my company. And during due diligence, there's a question of, well, who's playing what role? Well, they're looking around for somebody that could sit in that seat, and they're not there. And so those earnings are not transferable. And we see this quite often when our clients are out looking to buy companies to bolt into their platform. The businesses that they are buying quite often are made up of these owner operators who have played multiple roles. And then we've had to remind, bring it to their attention that they're not giving us a pool of earnings that is going to be easily transferable, because all the relationships are with the owner who is selling, and the likelihood of us being able to keep them, don't have the same relationship, is in question. So that has an adverse effect on value, and it also has an adverse effect on on terms. Probably most often we see it in the way that the terms are resolved, like how the value is paid. But what I see is from businesses are going through the valuation exercises, they're either looking back at the last few years of earnings and they're coming up with some number that they feel represents their ability to generate income into the future that would be sustainable and transferable, or they're looking ahead at the future. And in most cases, the transitions that I see that are looking to the future are selling to outsiders and showing what the possibility is of continuing to execute on the growth plan. So what I want to talk about is this T value, which is tied to this transferable component of the valuation, and that the R factor is the relationship factor, or the responsibility factor, or the role factor, and that if there's a really high reliance on the owner for either relationships or senior roles and responsibility, then I've seen a correlation, an inverse correlation to the amount of the purchase price that comes in cash at closing. So if the owner is very, very, very involved and owns relationships with clients and is responsible for key functions in the organization, in a transaction, the transferable value of that cash flow means that the buyer is going to be somewhere down here, in that they're not going to be willing to write the big check. The transaction will have a lot of terms in it based on the ability for those earnings to be realized in the future without either with the person playing the role as an employee or without the person, and then they've transitioned responsibility to key employees. If, on the other hand, the owner's done a good job and the team is very capable, and there's a highly functioning leadership team, then chances are we're going to get a really high amount of cash at closing. And I've never had any client get 100% of their sale proceeds in a third-party sale in cash. So my range would be 80, I would say 80%. In many cases is a really good outcome for a sale, but others perhaps have experienced 100% and good for them. They really did a good job in creating transferable value on that, and the buyer was very confident in the future. So the T value in the valuation calculation is, from my experience, is probably one of the things that owners can work on in advance of a sale. So if you are looking at selling to outsiders and you don't have anybody that's playing roles, then chances are your transferable value is going to be low and your cash at closing is going to be low. So you might decide to wait a few years to sell. In the management piece, this is going to be essential that the leadership team has the ability to assume responsibility for these roles so that they can meet the expectations of the lender who is going to help finance the transaction. So how do we go about helping buyers then that are basically participate in creating this transferable value? So we got this management team that has done the work, the owner has given them responsibility, and now we want to reward the management team with something that would be a piece of the action. So what I have up here is, this is a way for us to create some form of reward. That reward could be cash or equity. And so when I say cash, it'd be when the reward is paid out, and then the participant receives cash, and then either A, they're using it to get the bank financing, or B, we're giving them equity, which would be ownership stock that they may be using cash to buy along the way. But either way, we're ultimately trying to make them become more bankable. And so there's the reward that's for, we'll call it buyout, which would be tied to our desire to get bank funding when we basically achieved this level of responsibility on the seller's part. So we got low responsibility. We want to do a buyout. We need to create some equity or cash for the buyer. The bank's looking for certain outcomes. And then we're targeting the plan so it meets the needs of the bank and the buyout. And typically what the bank is looking at for financial ratio starts off with, in my experience, the debt service coverage ratio, which is the ability for the business to service principal and interest with after-tax earnings. And typically what a bank that I've seen is 1.25 to 1.5 of after-tax profit. So they need $1.25 to $1.50 of after-tax profit for every dollar of principal and interest. So in the design of a incentive plan for the participant, where the company's saying, we are going to put some money aside for you in an account that could be tied to the business value or tied to an interest rate. At some point in time, we're going to pay that out to the key employee per the agreement, and then they're going to use that money to buy in to the company. So we design these if it's going to be cash, we design these deferred compensation agreements, deferred bonus agreement, that is tied to the exit path and the timetable that we're seeking based on the goals that the owner had is when they want to be out. If it's for a reward, is for incentives. Let's say we've got some people that we want to keep through the transition, whether it's to sale to outsiders or sale to management, who won't be part of the buyout if it's a management buyout, and we want to do something for them. Then what we do is we come up with a bonus agreement, build an account for them, and it could either be tied to the sale value. That's typically for a third-party sale, or it's tied to some target value based on what the key employee said they wanted. So in past, for clients who are looking at selling their companies to outsiders, they've had us interview the key employees that were driving tremendous amount of value, but had yet to be given anything that would compel them to stay with the organization through a change of control. So we put in place these stay bonuses that are designed to reward the key employees based on the sale proceeds that we got, and the valuation of the sale, and then they were able to then use those proceeds to go out and do something with. For example, I interviewed some really high performing salespeople and asked them what it was that they would like to have happen if the organization were to be sold and there was going to be a change of control, and what would they want to have happen that would compel them to stay. And the significance of this conversation was that these salespeople represented probably 30 or 35% of the earnings, the gross margin of the company, 2 people. And this is a $80 million business. So we definitely couldn't afford to have those guys walk away, because then the value would run out the door with them. So we interviewed them, they told us what they want, and we came up with the target value that was basically defined in the agreement. So when we do these plans where the companies are setting money aside for a key employee and build an account, and then we have an agreement, we are either doing it to reward them to participate in the buyout, and then we create a deferred comp plan that is specifically paid out when the buyout's going to occur. And we've come up with a way to get around some of the rules in 409A that allows for the money to be available very flexibly, but it's tied to specifically a sale. And then for those where we're just trying to keep key employees on the team through a transition who aren't going to be part of the buyout, then we tend to either A, ask them what it is they want, or B, we use psychographics to figure out, you know, based on their compensation and their employment history, what percentage of their compensation would we need to have available to them at a sale in order for them to be willing to stay. So those are the two aspects of these deferred bonus plans. Now, back to the bank. When we work with our clients on dealing with the bank, we're not starting with the debt service coverage ratio. We're starting with where are we with the team, and what is the team's ability to assume responsibility. If we know that the team has the presence, the credit history, the ability to inspire and lead and make a lender feel confident that this individual is capable of repaying this loan in the future with money that we don't have yet, because that loan is going to be paid with money in the future. That's our goal, is this person capable of compelling that lender to do that? If they are, or we feel they're capable of getting to that point, then what we're doing is we're targeting how much down payment do we need in order for us to have the debt service coverage ratio that would be necessary to service whatever value we are trying to buy. And we model that out in various scenarios. And typically what we're doing is we're putting together a forecast of the company's future performance along with its past. And if it's not an incumbent lender, which in many cases, we're working with the incumbent lender because that's the organization that has the most history with this business, then we don't have to give them past financial information because they've probably been getting it to meet lending requirements for their line of credit or any term loans that they have. But either way, what we're doing is we're putting together a financial package that illustrates the future and then what has happened in the past. We're doing some modeling to see how much debt can this thing support, what terms are going to be acceptable to the seller and still be within this debt service coverage ratio. And then we go to the lender and talk about our plan and ask them, what guidance do you have? And we try to get the lender involved as early as possible, because it's been our experience in these transitions that having the lender alongside us all the way through the transition, if we're going through a 3 or 7 year period, we want that lender in on meetings. And that on that 7-year transaction that I shared with you in that general contractor construction company, every year we had a meeting with the lender and the other advisors just to go through the plan to bring the lender into where the business was, how it had performed, how it's impacting the plan, which was involving this deferred bonus agreement that was going to help fund the buyout. Were we on track? Because the lender was looking at us creating a pool of cash that would be roughly 25% of the purchase price based on the terms that we had asked them for. And so we showed them our progress, and the progress was basically based on company performance. So the key to the banking side is twofold: have the financial ducks in order, have yourself a capable buyer who can sit in a meeting with the lender and develop a relationship and demonstrate to that lender their ability to lead the organization. And if you do that, then it's been our experience that the transaction is ultimately can be bankable. Now, I've not met any lenders yet that are willing to guarantee a loan, years in the future. There's no way we're going to get that, but at least we're increasing the likelihood that they understand what we're looking for and they feel good about the buyer and they aren't as concerned about the buyer's ability to repay that note. So, in conclusion, if you're looking at transitioning out of your company, it's in your best interest. Think about what it is that you want to have happen. What would you like to look like for you? And then engage with your financial advisor to confirm that what you want is understood by everybody, what that number is. Understand what your business value is so that you can see whether or not there's any deficiencies which might influence your timetable. And then look at your management team and ask the question, would I invest in these guys? Because that's what the banker or the third party buyer is going to be looking at. Is this management team capable of running that organization? If you do just that, then chances are you'll have a sense of confidence of what's possible. And then if you want to get beyond that, then you can call me. And you can reach me on my website at the McFarland Group. I got white papers and videos, and I shoot videos every week of business tips, which you can find on LinkedIn. Our firm has deep expertise in ownership succession and management compensation, and we would be happy to provide guidance and hope to hear from some of you someday. And that concludes my formal comments.
That's great. Thanks, Byron. Anyone on the call? Would anyone want to jump in with questions or anything else for Byron?
John Vance.
Hi, Byron. How you doing today?
Good. This nice profile picture, John.
Thank you, sir. Always intrigued to hear what you got to say. And for those on the call, I've worked with Byron myself, and very much would endorse his services and help me through my process of purchasing a business. So we can't endorse him enough. But good presentation today. Thanks, Byron.
Oh, thanks for attending, John. Always good to see you, buddy. I'll send you your check.
Well, we will close it here, but I guess I'd encourage everyone to reach out to Byron or to any of us if you want to go further, look deeper into these topics. I think that was an excellent overview of how to approach the topic with excellence and do the right things. And I think every service that we provide at Nebraska MEP is built to add value to your business. So if you're going through that plan, you see some shortcomings or opportunities, I'd be happy to go further and talk about how to shore some of those things up and maximize the value. But I think we'll shut it down here. Thanks a lot to everyone.